In many competitive markets, companies often face the challenge of intense rivalry, commonly known as competing in red oceans. These markets have clearly defined boundaries, where products or services are quite similar, demand growth is either slow or limited, and maintaining a competitive edge is tough. When firms compete in these environments, they often enter damaging price wars that erode margins, weaken brand strength, and hurt financial health over time. This is what we call a red ocean trap. It contrasts sharply with the idea of a blue ocean strategy, where businesses aim to create new market spaces with less competition by innovating value. Still, most companies find themselves operating in red oceans and struggle to avoid falling into the cycle of cutting prices as their main strategy. This presentation will dive into why companies so often get caught in these traps, what drives price wars, and how to recognize and steer clear of them, all while offering practical examples and insights on balancing competition with sustainable business growth. The term red reflects the tough, sometimes ruthless competition that colors the marketplace as companies battle over a limited group of customers. A price war happens when companies keep lowering prices to outdo each other, often because there's too much capacity, products aren't seen as very different, growth targets are aggressive, or there's pressure to boost sales quickly. While cutting prices can increase sales initially, ongoing price wars usually hurt everyone's profits without giving any company a real long-term edge. Companies get caught in these traps for a few reasons. One is weak differentiation. When customers don't see much difference between products, price becomes the main factor, making it hard for firms to charge more or justify spending on better features, so they end up reducing prices just to keep sales volume. This tends to happen in industries like airlines, consumer electronics, and fast-moving consumer goods. Another reason is overcapacity combined with high fixed costs. Companies need to keep their resources busy, which pushes them to lower prices to fill that capacity even when it's not ideal financially. These structural, strategic, and behavioral factors together keep firms stuck in price wars despite the risks. When spare capacity increases, firms often lower prices just to cover their variable costs, which prompts competitors to retaliate by cutting their prices as well. This cycle pushes prices below sustainable levels, a pattern we see frequently in industries like manufacturing, airlines, shipping, and hospitality. Many organizations fall into the trap of equating market share growth with strategic success, even when that growth isn't profitable. Managers might prioritize increasing volume over maintaining healthy margins, assume that scaling up will eventually fix profitability issues, and overlook the long-term damage to their brand. As competitors react defensively, this creates a damaging price spiral that locks the entire industry into a harmful cycle. This situation is often worsened by short-term, reactive behaviors where one firm cuts prices, competitors quickly match or undercut those cuts, and no one gains a lasting advantage. Instead, industry-wide profit margins shrink. The fear of losing customers drives firms to sacrifice their profitability rather than look for smarter, strategic alternatives. Internal performance metrics sometimes push companies toward price wars without meaning to. This can happen when sales targets focus mainly on volume or when incentives reward revenue growth rather than profit margins. Also, short-term evaluation cycles often encourage quick wins instead of long-term stability. These approaches tend to reward immediate sales gains but can hurt the company's strategic health over time. Understanding these red ocean traps is important because it helps protect profit margins by avoiding value destruction, encourages a disciplined approach aligned with long-term strategy, and frees up resources that could be better spent on innovation and customer experience. Additionally, being aware of these traps allows leaders to better anticipate competitors' moves and manage risks before making pricing decisions. This awareness ultimately supports healthier competition and stronger business performance. To avoid getting caught in price wars, companies need to take thoughtful, strategic steps rather than quick pricing fixes. One key approach is to strengthen differentiation by going beyond just product features. This means building a strong brand identity, delivering excellent service quality, creating a great customer experience, developing an ecosystem of offerings, and adding emotional or symbolic value that makes customers see the product as unique. When customers perceive this kind of unique value, price becomes less important. Another strategy is to compete based on value instead of price alone. Companies can do this by redesigning their offerings, bundling services together, focusing on the total cost of ownership rather than just upfront price, and emphasizing the outcomes customers will get instead of just features. This shifts the competition away from price cuts and towards creating value. It's also important to segment customers strategically, recognizing that not all customers react the same way to price. Businesses should aim to keep premium customers with differentiated offerings while serving more price-sensitive customers through separate, low-cost alternatives, which helps protect the core brand position. Finally, redesigning cost structures can support these strategies by enabling more flexibility and efficiency. Together, these approaches help companies avoid falling into damaging price wars. Sustainable pricing relies on achieving cost leadership, which can be built through process innovation, digitalization, and supply chain optimization. These strategies enable companies to offer competitive prices without triggering harmful price wars. Changing internal incentives is also crucial. Instead of focusing solely on volume or revenue, performance metrics should prioritize contribution margin, customer lifetime value, brand strength, and sustainable growth. This shift discourages price-based competition driven solely by hitting sales targets. Looking at real-world examples, the airline industry shows how full-service carriers often lose margins when matching prices with low-cost airlines that have structurally lower costs. In retail, supermarkets frequently start price wars during economic downturns to attract customers, but this undermines margins, supplier relationships, and service quality over time. Though the slide mentions smartphone markets, the examples already illustrate how price wars in different industries cause lasting damage without proper cost leadership and incentive alignment. Mid-range smartphone providers face intense competition that has driven prices down, pushing companies to focus more on creating unique software ecosystems and services instead of relying solely on hardware. A similar pattern appears in ride-sharing platforms, where early growth heavily depended on price subsidies to attract users. While this strategy helped quickly increase adoption, many platforms found it hard to move beyond price-based rivalry to establish profitable models. Price competition, especially in saturated markets, does have some benefits. It can quickly boost volume by increasing sales or usage, help absorb excess capacity through lower prices, and discourage new competitors from entering the market in the short term. However, these advantages are usually outweighed by significant drawbacks, including the erosion of profit margins as ongoing price wars cut into industry profits, damage to brand value as lower prices reduce perceived worth and equity, and a narrow strategic focus where companies prioritize short-term pricing tactics over long-term innovation and differentiation. This balance highlights the complexity companies face when navigating price competition in crowded markets. Industry instability often results from long-term declines in investment, which ultimately harms customers, employees, and suppliers. To move away from destructive price wars, it's helpful to think in terms of blue ocean strategy. This approach focuses on creating new demand, redefining value propositions, and breaking the traditional price-value trade-off. While it's not always possible for companies to completely leave highly competitive, crowded markets, known as red oceans, applying blue ocean principles within those markets can lessen the dependence on price competition. The reason companies frequently get trapped in price wars, despite knowing the risks, comes down to weak differentiation, too much capacity, obsession with market share, reactive behaviors, and poorly aligned incentives. These factors make price wars seem unavoidable, even when they are damaging. Avoiding these traps requires commitment to discipline and long-term thinking, along with focusing on value creation instead of just price cuts. By enhancing differentiation, prioritizing customer value, redesigning cost structures, and aligning incentives with sustainable outcomes, companies can stay competitive even in tough markets. In the end, the firms that succeed are those that steer clear of price wars altogether by shaping competition in ways that protect profitability, strengthen their brand, and build lasting strategic advantage.